In this episode, we will talk all about refinancing your mortgage, what it is, why you may consider doing it, and what are the costs associated with the process. Welcome to the neighborhood. Hello, neighbors. It is the middle of September, and we are here with episode 8 of the Neighborhood Money podcast. And Drew, do you know what the middle of September means?
I do not know what the middle of September means.
It is officially pumpkin spice season, and I could not be more excited.
I was surprised you say middle of September because my wife has already had candles burning with pumpkin spice and drinking pumpkin spice.
I have at least a 2 to 3 week minimum wait when the first pumpkin spice stuff comes out until I fully indulge. But let me tell you, I've had pumpkin spice in my coffee every single morning for the last week, and it makes my day so much brighter.
Oh man, I really expected a lot more out of you, Cav. I
What can
don't
I say?
really
I'm quite
touch
the
that
sucker.
stuff. I like my coffee black and nothing else in it.
I only do pumpkin spice, and then I also love the pumpkin spice lattes over at Starbucks. So yeah, this time of year is just fantastic.
Yeah, and then I'm sure when Christmas will come around, you're gonna be wanting the peppermint ones too.
No, I actually can't stand peppermint. It's just disgusting. But the pumpkin spice, it's got me wrapped around its finger.
All right, there you go.
Well, if you're new here, welcome to the Pumpkin Spice Latte podcast. We are your hosts of the Neighborhood Money podcast, a video podcast here to grow your financial knowledge and build the life you deserve. My name is Cavan.
And I'm Drew.
And we're really here to serve you and hopefully building that financial knowledge and really building that foundation and hoping to bring you a lot of value into your life that you can apply every single week. To really support this podcast, there's really three main ways you can do so. You can follow us on all of our social media platforms. So we're on Instagram, Facebook, and Twitter, as well as over on YouTube. We do have a video version of this podcast. So if you want to see that, please go over there and subscribe to our channel. Like the video if it brings you value. And then lastly, if you're listening to the audio version, whatever podcast platform you're on, please rate and review, as well as follow and subscribe to this podcast so you're notified of any new episodes that we list. We do list podcast episodes every single week, and those ratings and reviews go a long way to support this podcast. And in doing so, Drew, what is our neighborhood review of this week?
This week, our review is from our neighbor Eric, and what he has to say is good info and well grounded. Looking forward to what comes next from these guys. Well, Eric, I'm pretty excited to see what comes next from us, too. I don't know exactly where it's going, but with the help of our neighbors and commenting and liking our stuff, we'll start figuring out exactly where we're going to be going.
Or we might even become a coffee podcast. Who really knows with how this episode started out? So, the main topic today, Drew, is all about mortgage refinancing, what it is, why you should consider or potentially consider refinancing, as well as what are those costs associated with refinancing. So, if we really dive in, what is refinancing your mortgage? What is that ultimately doing for you?
Yeah, I think the what of refinancing is kind of a good place to start. I've been having people ask questions to me if they should refinance or not. I think you see a lot of commercials about refinancing and you just hear refinance, refinance,
Mhm.
refinance. And it seems like such a good thing. And I'm hoping what we can go through is just kind of tell you what refinancing is and, what to think about with that. So, with that said, refinancing is the easiest way possible is a new loan for your existing loan at potentially better rates, terms, or payments.
Yeah, that's a really good way to put it. It's essentially replacing your current loan with a new loan, whether it's through the company that you're currently working with your current mortgage company,
Yep.
or a different company that's looking to take on your business and take over this loan for you.
Yeah, absolutely. As we were saying with the banks buying out your old loans, it would just be whatever's existing left onto your loan or whatever you're outstanding, if whatever your equity is potentially also in it too, is what they'll be purchasing and then switching over to their bank.
So it's basically just resetting your current mortgage. And like Drew, you were saying, you can do that in several different ways. So you can drop your interest rate, and that's ultimately what most people look at when you're refinancing. You can
Mhm.
change the duration of your loan term. So if, say, most people take out a 30-year loan, you can really change that to a 15-year loan, a
Yeah.
20-year loan, or even re-up a 30-year loan, really depending on what your ultimate goal is for refinancing.
Yeah, finding out your ultimate goal, I hope is what people can figure out as we're going through this episode. 'Cause I know it's a lot of times some people just want that payment lower. Maybe they're not
Mhm.
really caring about where they're how much they spend in interest after 30 or, if we refinance potentially 40 years or whatever it may be. Um, and then some might be looking at the numbers. I'm sure you or myself are like to look at interest rates a lot and say, "Hey, how much can we save over this, 30 years?"
Yeah, I think the monthly payment one is a big one that people look at frequently.
Yeah, and there's a lot of times with that monthly payments, it might be one giving them more flexibility in their month to month finances. Two, it might be, there was something they wanted to splurge on, and that maybe gives them some more extra or some extra cash to do so. And
Mhm.
maybe they want to use the extra money to put into investing from maybe the knowledge that they learned from the Neighborhood Money podcast.
Yes, I would definitely urge people to pick that third option. But I think, Drew, like you were saying, you and I really like to get into the numbers. And I think a really big thing about refinancing, like you were saying, is people do focus on the monthly payment, but it's super important to look at the total cost of refinancing in your ultimate picture. And so it can be really easy to go into a refinance and say, okay, well, interest rates have dropped by, let's just say, 1%. So I know my loan is going to drop, let's just say, by $200. That
Mhm.
might be very enticing. But I think one thing to really consider is that while your mortgage payment has dropped, you might be paying more interest over the long run, depending how you structure this refinance and when you go and restructure this refinance. And so I think, really to dive a little bit deeper into refinancing, the first thing to really talk about is interest rates. That's the one that gets the big, gets all of the attention when we talk about refinancing. People say, oh, interest rates are so low. It's such a great time to refinance.
Mhm.
And that might be the case, but it's not always the case.
Yeah, for the interest rates, some of the things I've been hearing or what you may hear is if you get more than 1% interest rate, decrease, then it's going to be beneficial in the long run. I've also heard 2%. But, the funny thing is a lot of the times I saw 1% as being beneficial. They were from lenders or banks
Who want your
articles on
business,
the internet that want your business.
right?
So with the 1%, I think there could be a case for that depending on calculations. But if it's 2%, there's I would say a stronger case of saying that would be a good chance and a good time to refinance.
And even beyond just, what percent you're saving, I think it's also important to remember that there are people out there that have variable interest rates. When interest rates are so low, it's an excellent time to go to a fixed rate. And, in my opinion, I think that's ultimately what you want when you look at a mortgage. You really want to lock in that interest rate, specifically now in such a low interest rate environment. Rates aren't going to go much lower. They already have climbed back up from their lowest point, whatever it was 6 to 12 months ago. They're going to start rising. Who knows where it's going from here?
Mhm.
But regardless, locking in that low interest rate is going to be very crucial to opening up more room in your budget to invest and to do other things
Yeah.
in your financial
Th-
life.
There, like as you were saying, there's not much more of a floor that these interest rates can get to. So if you were in a variable interest rate loan, this would be a very good time, as you were saying, to go to that fix because there's not going to be much buyer's remorse if it goes down another 0.25% or 0.5% because that's really not going to be changing much as you go into the long term.
But before you go out and, go and get a new or get a refinance, one thing to
Yeah.
really consider is where you are in your mortgage. So although low or interest rates might be extremely low right now,
Mhm.
it might actually be more expensive to go out and refinance. And let me tell you how. So let's just say you had an original 30-year loan and you're about 10 to 15 years into it. Well, the way interest rates or mortgages are set up, it's called an amortization schedule. It's essentially a schedule on how much interest and how much payment you pay each payment over the course of your mortgage. And so amortization schedules are really established to pay a lot of interest upfront, right? Because the banks want their
Mhm.
money. So you pay a lot of
Yeah.
interest upfront, and then later on in the loan, you start paying a lot more of that principal back. But you got to look at the total costs of where you are. It might actually be in your favor to actually just pay off the rest of your mortgage because when you get a new loan and you refinance, you are resetting that amortization schedule. and you're going to start paying a lot more interest again.
Yeah, so when you're saying resetting that too, you can even think about it as easy as if you had a 30-year loan out and you paid on it for 10 years and you wanted to refinance for another 30 years, you're going to eventually be paying for 40 years on this house mortgage of yours.
And that's why it's so critically important to look at the total cost, right?
Mhm.
You can't just look at how much it's going to save you per month. You got to look at that big picture and get into the numbers, even if you're not a numbers person, because it's very
Yeah.
important to make sure that you're aware of how much interest you either are saving or spending, depending on your current
Yeah,
situation.
with with these amortization schedules too, as you're saying, they get paid a lot up front. And just an easy way of thinking about that too is that interest rate is always coming off of your outstanding balance.
Hmm.
So if you think about it, if you had that house for $100,000, you're taking that interest rate, that maybe that 5% that's coming off the 100,000, and then after your next payment, it's coming off of maybe it's 99 something. So there's
Right.
always that high interest dollar amount coming off of your high outstanding dollar amount. So as that gets lower and lower, there's less interest to be paid on that.
And so that naturally segues us into, well, we talked about the interest rate, but what about the length of the mortgage? And I think, Drew, like you just alluded to, it's very easy to say, oh, I'll just get another 30-year mortgage
Yeah.
because my payments are lower. Well, I think you really got to look at where you are in your current situation, because a 30-year might not make sense. I think you really need to weigh the odds of, let's just say, a 15-year term versus a 30-year term. So with your 15-year term refinance or just mortgage in general, your payments are obviously going to be higher, but you're going to save an awful lot on interest, and that's an
Hmm.
expense. Whereas a 30-year is kind of flipped. Your mortgage payments are going to be lower, and that's
Yeah.
going to ultimately make you pay more in interest over the course of your mortgage.
That's just it all depends on where you wanna be in that situation of yours. It's that 15-year, you might be looking at that and being like, "How do I have a higher payment right now?" And
Yeah,
then, that just goes along saying, "Hey, it's a shorter period, you are getting a better interest rate." And on top of it, this mortgage of yours is gonna be paid off sooner, and it's potentially gonna be right around the same payment that you had before, which is pretty
right.
awesome.
And I think, one thing, if you are going to be consistent in this, is when you're looking at a 15-year mortgage or when you're looking at your mortgage in general, see if a 15-year mortgage payment fits into your picture. I think that's a really
Yeah.
good feeling on if you're staying within budget when you're buying a house. And then I think you can extend out to a 30-year payment, because that gives you flexibility, because you can always pay off your house in 15. Always make sure that you don't have prepayment penalties, but you can always pay it off in 15. And so that gives you some flexibility in your monthly budget. And Drew, what I like the most about this strategy is that you can actually invest the difference between your 30-year payment and your 15-year payment, and just say you put it into a very simple basic S&P 500 ETF or index fund that has on turn average around 10%. You're going to have an awful lot of money at the end of 30 years if you are diligent and consistent on that investing, the difference between those two monthly payments.
Yeah, it is interesting to think that you could refinance or you could use your house as a way to help your investing in your retirement for the future. But as long as you can keep yourself disciplined and have that flexibility, I think that's the biggest part of it too is,
Right.
you know, you don't want to do it for the wrong reasons, I guess I would want to say.
Yeah. I would definitely say don't refinance solely to have more money in your budget to invest, right?
Yeah.
But I would also say that, if you're in those first couple of years into a 30-year mortgage, it might make a lot of sense to go for another 30 to get those lower interest rates. But if you're further along, I would definitely just recommend considering looking at a term that's closer to what your current or whatever you have left of your current mortgage is.
Yeah, and just to move on from here, I think it just goes into, we've said what kind of that refinancing is. We just talked about some other areas of the interest rates and the terms potentially. And then, you get that information and you say to yourself, okay, if it was something I would want to do, how can I qualify for this refinancing?
Qualifying is a really big piece too, because not only does it affect if you can refinance, it also
Mhm.
affects, what your interest rate is ultimately going to be. So if you really want to have the lowest interest rate that's available from your bank or from what credit union or whatever, you're going to have, certain things in place to show that you are not a risky individual to loan to. And so I
Yeah,
think
say I would say, that risky part is a really good thing to think about. Is if you're going into a refinance just because you want to do a refinance, you have to think about the bank's trying to make money too. And if it finds out to be too risky for them, they might not even want to touch you.
exactly. And so one of the biggest things, right, is your debt to income level. So if you have this house, if you have a car, if you have student loans, if you have all of this different debt, it's going to be
Hmm.
very challenging to refinance at a lower rate or to refinance at all. And so, one step you could take there is to really decrease your debt. So really take control of those smaller debts, whether it's student loans, a car, credit
Hmm.
card, whatever, decrease that because that's ultimately going to improve your debt to income ratio, which will allow you to have a better chance at qualifying and not just
Yeah.
qualifying, but getting a better interest rate.
And just to piggyback on that debt to income ratio, there's also almost an easy bar napkin calculation that they like is this loan to value of right around that 80%.
Hmm.
So going back to just some simple numbers of 100,000 and you have 80%, that'd be 80,000 left on your loan and your house is valued at 100,000, you can see that 80 to 100.
Right. So it's ultimately your amount of debt you have out to the value of your house. And, there's some ways you can have some wiggle room here. Not only when you pay down your current mortgage, you're going to
Mhm.
see your debt or your loan to value decrease, but you could also get your house appraised. Obviously, that comes with a cost, and that
Yeah.
will also improve or increase the value of your house, which will ultimately decrease that percentage that Drew was just talking about. And another really cool feature, Drew, about when you're looking at loan to value is when you drop it. Let's just say you bought a house with 5% down.
Okay.
Well, with that amount of money down, you're going to have to pay property mortgage insurance or PMI.
Yeah.
And when you pay PMI until you have about 20% or until you have 20% equity in the house.
Mhm.
Well, when you refinance and you have 20% equity, or the flip side is 80% loan to value,
Yeah.
you can ultimately eliminate that PMI and probably save yourself a couple $100 or whatever it is per month.
Very good thing to think about there.
And I think another thing when we're thinking about how you qualify is again looking at your credit score. And so we talked a little bit about knowing what your debt to income level is, but also just being diligent and having timely payments is really going to help you to be able to get those lowest interest rates when you are qualifying for a refinance or when you are applying for a refinance. Because again, guys, this is just another loan replacing your current mortgage. So just think of it as basically a brand new loan. So you're gonna have to go through all the process to get it.
Yeah, and as we said in our last episode with credit cards, is we talked about hard pulls. And if you did go in for a refinancing, they did a hard pull on your credit score, just keep in mind that there is potentially there will be a drop in your credit score, but it's only about, 5 points or so.
But I also have to account for cars and all that stuff. So if
Yeah.
say you bought a new boat, a new car, etc., in the last couple of years, you might not be looking too hot to refinance, and so you might have to actually wait a little bit to do that. But then again, it doesn't really hurt to see what your options are. Go out there and shop around and see what's available to you.
Yeah.
But Drew, why would we want to ultimately refinance? Why wouldn't we want to just stay in the current path of whatever mortgage we're currently in?
Yeah, I would say the first one that comes to mind that you hear over and over is the monthly payments. It's, anybody wants to have a little bit extra cash in their pocket or the flexibility to do things with. So I think that lower payment one is definitely a why for some people.
Yeah, I think so too. It does bring that flexibility, but you do again have to be careful here because you don't want to just refinance to have a lower payment so that you
Hmm.
have more room in your budget. And so I think it's really important to first look at
Hmm.
why am I wanting lower monthly payments? Is
Yep.
it because, I have a car payment? Is it because I'm spending all this money going out to eat? Or is it
Hmm.
because I want to truly benefit from a lower interest rate, a different term. So my whole mortgage is cheaper to me over the long run. And I think that's something you really need to consider.
Yeah, and as we said earlier too, is these lower payments, if that is a why for you, you may just still be making those minimum payments and just remember that that mortgage could be drug out much longer than you initially wanted it to.
Yeah, absolutely. And I think the second reason why someone might want to refinance, and probably, we already talked about it, the most common reason is those lower interest rates.
Yeah, these lower interest rates are definitely very, very enticing, especially for somebody that likes Excel like myself. I like to do all those
Hmm.
little calculations and seeing where it's at. And the interest rates are always a fun one to play around with for me, where you can say, hey, if you if I lived in this house X amount of years, you do all these what ifs
Hmm.
in your calculations, which are awesome, and say, okay, I lived here for this long. I took out this type of loan. Where am I at? How much am I saving on interest rates? And then you say, hey, what happens if I add a little bit more to my payment every month? How much more am I saving on interest? So that long-term view is the interest that you have to think about. So when for me, if I look at a lower interest rate, it just I'm looking at the long term of this big payment of mine.
And I think it's really important to take that long term approach. And I know, Drew, you and I are both, Excel junkies, but if, you out there, the listener is not, there is plenty of online calculators that can walk you through this. You just have to provide the inputs into the calculator and it'll help you out. Just go to your good friend Google, look up mortgage calculator, look up mortgage refinance calculator. There's a lot
Yeah.
out there. A lot of the big banks provide them. And so just start playing around. If you are considering refinancing, just look at what the, general new mortgage rates are for the term you're looking at, and then compare that to what you're currently looking at and look at that total picture of how much you're going to be paying, and then also
Yeah.
look at what your monthly payment is and really get that good picture of, what a refinance could do for you.
Yeah, I actually went out on the internet just to see what they had out there for calculators, and majority of the bank websites will have them. I've also there's two websites, one is Bankrate and the other is
Hmm.
NerdWallet, and they have very I think they're really cool calculators. You just type in, your information of your original amount, interest rates, date of origination, and they'll compare that to what interest rates are currently,
Oh, that's
and
cool.
they can actually even send you out to where these rates are coming from, and then they give you these big colorful graphs of, how much you save after 5 years, after 10 years, after 30 years, and you can even add in all those other scenarios. So they're very easy. You don't have to put them together yourself. You just go to uh, the old Google machine,
Yeah.
type in mortgage calculator, and it'll be right there for you.
Yeah, you gotta love getting your hand held through some of these more challenging mathematical concepts and equations. So I love it. We already did talk about another reason why you should consider a refinance is to get to that fixed rate interest rate. If you're in a variable interest rate right now,
Mhm.
given rates are so low, they can only rise from here. Generally speaking, obviously we can't predict the future, but it's really great time to lock in that low interest rate for your mortgage.
Yeah, fixed rates are wonderful right now, in my opinion. If you like the predictability, then there's really no better time than now. I think those I could be wrong, but in my opinion, those variable interest rates, it was, when there's a lot of fluctuation in these rates, or when the rates were initially 10, 12%,
Hmm.
even 20 years ago. So these variable, in my opinion, those last couple years, you don't really save a whole lot on that change.
Yeah.
I don't know what your thoughts are on that, but as of right now, for how low rates are, I don't think they really go much lower.
I can't imagine they would either. Looking historically, they're at historical lows already. So, I mean,
Yeah.
yes, they can go lower. And so, given that rates are so low currently, there's really not a better time to lock that in. And then, another reason is to look at refinancing and consider it is really to reduce that loan term. So, how long you are ultimately paying on your mortgage.
Yeah, I think we even said a little bit earlier, if you wanted that 15-year, you wanted that 30-year. That's just another thing to think about, and I wanna say it goes back up to the monthly payments as well, if
Hmm.
it's in your mind. If you can go refinance for a 15-year and you're spending, or not spending, but your payments are very comparable for your 30-year, why wouldn't you wanna knock off a couple years and have that extra cash in your pocket at the end?
Yeah, I completely agree. Look at that total picture, and if it can reduce your monthly payment and save you on interest over the
Yeah.
life of your loan, that's ultimately you want to do. We'll get into it a little bit. There are some other things to consider, specifically the
Yeah.
costs of refinancing,
Yep.
but that's at least one way to start looking at it. We're really harping on it. I think in this episode is just be super aware of that big picture of refinancing. Be aware of the amount of interest that you're paying over time, and really compare that to your current situation.
Yeah. I think that's very good. Very well put. Very well put.
And then the last and my least favorite, and would never recommend this to anyone, but I think it's important for us to have the conversation here, Drew, at least
Hmm.
getting it on the table because people do this very frequently, is what they
Hmm.
call a cash out refinance. And so
Yeah.
we talked a little bit about equity. And again, what equity is in a house is the amount your house is worth minus the amount you owe on your current mortgage. And so let's just say you have, like Drew was saying, $100,000 home, you owe 80,000, you have $20,000 worth of equity. Well, what banks will let you do is what they call a cash out refinance, is
Hmm.
that $20,000 of equity, they'll let you take out up to about 80% of that value in cash for you to do what you want. So this can be used for things like home improvements and renovations. You can also use it to
Hmm.
consolidate high interest debt. And really, I mean, I guess ultimately you could just spend it however you want. There's really no terms around it, but it is available to you as a consumer.
Yeah. These are kind of scary to me. In my opinion, on these refinance or cash out refinancing is depending on what the value of your house is when you do it. If there's a big crash in the housing market, you might be stuck with a loan that
Right.
you can't cash. I mean, you can't even sell your house and pay off that loan. So
Yeah. I
that
mean, you're going to be underwater for sure.
you're gonna be underwater right away. If that's in a worst case scenario, obviously.
Yeah.
But also having that big chunk of cash that's just sitting in your bank account too, it's very hard to not say, well, I'm only going to use a little bit for vacation, or I'm going
Yep.
to use a little bit for, I want some new shoes or some
Hmm.
sunglasses or something. I think it's just really easy to spend money if there's a large chunk and just sitting there in your cash account, unless you can be very disciplined and have a budget that you're stuck on. But if that was the case, then maybe I don't know, maybe you didn't have to do a cash out refinance.
Yeah, I would say that you're probably right that if you are on a budget, if you are,
Mhm,
have a financial plan, you probably aren't using a catch out refinance to fund a vacation.
mhm.
The reason I don't really like the cash out refinance situation is because I don't really like, specifically looking at like consolidating debt. I don't like the idea of, it's kind of reverse of what you said, Drew. Like, say you had high interest credit card debt. I don't
Yeah,
like the idea of putting that new shoes that you bought, or, that new TV you bought into your mortgage, because that's ultimately what you're doing. I
yeah,
think that's very dangerous. And it's just really a game that could really set you back financially. And most likely what will happen is when you do this cash out refinance, you're probably going to reset it for a 30-year term. And so not only are you paying for a new TV or new shoes in the situation, you're going to be paying for that for 30 years.
yeah, you're
And I think that's really
financing that pair of
dangerous.
shoes,
Right.
and
And
you're
it,
not.
it may seem like you're paying off debt with your equity, but you're
Yeah,
really not. You're just transferring where it exists.
yeah. I think what you're saying there too is a good point of saying with that cash out refinance, some of the reasons people have done it or like to do it, it is to consolidate that debt of saying, "Hey, I have a huge credit card debt out there right now. I need to pay it off, so I'm not paying 25% on it.
Hmm.
I have some other loan here. I just want to get all under one umbrella, under one payment." And in some households, maybe that just helps them, I don't know, maybe gets them their head just above water enough just so they
Right.
can kind of get back on track. But just you're gonna have to be really disciplined. You can't go back to your old ways.
Right.
There's also, that argument for house renovations and saying the amount of money I'm putting in, will I potentially get it out of my house in the future? So
Hmm.
there's also that too, but I'm sure there'll still be either money left over that you want to spend on random stuff, or you might put more into your renovation that you initially wanted to.
Yeah, and I think with the renovation side, you have to be very careful and knowing if it will potentially increase value of your home. again, remember there's no guarantee that any renovation is going to increase the value of your home. Statistically and historically speaking, there are certain things that do. But like Drew was saying, if there's a housing crash, you're not going to get that back. And so just
Mhm.
be careful when you're thinking about potentially looking at a cash out refinance to do a renovation or home improvement. One, if you do it, make sure that the renovation you're doing has some strong support in providing more
Yeah.
value when you sell. Otherwise, I would just say, as far away from it as you can.
As of everything else with refinancing, it's everybody's unique situation that they have in it, and
Right.
maybe there's a good reason for why people do it. It's what I hope we can just get across here is just some of if things were to go south, some things to think about with that cash out refinance. There may be
R-
some people that are completely good with it. I mean, it might even be good for some people, but there is very scary and very risky sides of it. And I just want to at least have that out there to get your mind thinking before you do it, or if you've done it, just to think about.
Walk through the things, at least in your head. You don't have to run numbers or anything, but
Yeah.
walk through the things in your head that what could go wrong when you refinance, whether it's cash out or not. Just
Yeah.
walk through your head like, how do these situations play out? And am I going to be in a good financial place regardless of the scenario? Obviously, there's scenarios that are going to be devastating to anybody,
Yeah.
but be realistic with it and really, really give it a really good thought when you're going through this process.
The thought's the biggest part.
Right. So that was really around the why you might consider refinancing. But I
Mhm.
think one thing that gets lost in refinancing, is a really big piece of refinancing, is the ultimate cost of refinancing. So we really talked, earlier about people really focus on the interest rates, lowering your interest rates. But that cost piece, Drew, that's a big piece, isn't it?
The cost piece, in my opinion, is the reason why you'd be doing it, right? You hear what it is, you hear why it is, but ultimately you're doing it for the money that goes in or out of your pocket,
Right.
right?
And I think, we talked a little bit about like why you might potentially refinance to save, but there are costs to actually getting the refinance. And so
Yeah,
that's when you think about having a brand new loan replacing your old loan, you're still going to have a bunch of different fees that go into it, because ultimately you're dealing with a business, a bank that's providing you
yeah.
this service. And so, you're going to pay on average around 5,000 ish dollars just to refinance. And that could be pretty costly, and you might actually not get that back depending on your current situation, what your goal is for living in your current house.
Yeah, you're really not gonna know what the exact cost of these until you actually go through it. I've
Hmm.
seen anywhere from 1 to 3% of your outstanding balance for closing costs. I've seen 2 to 5. I've even seen 3 to 6. So
Right.
I would just hit it right in the middle, say somewhere in that 2 to 5,
Right.
and depending on how your house is, how your credit score is, et cetera, what bank you use, and it just really depends on when you go through and actually go work with the lender. But those are things that you really wouldn't think about initially.
Hmm.
With the closing costs, you think, I can save so much per month, but how much is that closing cost or how much is that refinance costing you up front? And you even hear, well, hey, come with our bank and there'll be no closing costs. And
Right.
you have to you have to think, no closing costs.
Hmm.
Why is everybody else asking for it and you're not? You want my business that bad? And a lot of the times, as you go through your line items, you'll see that those closing costs are just put into your mortgage. So right now, instead of paying cash up front for those closing costs, you're now financing them over the length of your mortgage.
So, what are some of these closing classes? Do like a quick hitter, round robin, fast fire. So we have appraisal. So that's ultimately looking at the value of your home and how much it's going to be worth, so that they can potentially give you a loan. You also have getting your credit
Mhm.
report pulled, and that process to do that, as well as origination fees and things to that nature. Another one that you might
Yeah.
look at, and often gets brought to the table, is buying points to your mortgage. And so what buying points is essentially, it's roughly about 1% of your loan. It'll get you a
Yeah.
lower interest rate. So let's just say for $100,000 home,
Mhm.
you pay 1 point, which is equal to a cost of $1,000. So 1% of that loan. And that's going to drop your interest rate, let's just say a quarter percent or 0.25%. So you have
Yeah.
to really account for all of those fees when you're looking at refinancing. And one thing I will add here is that a lot of these can be negotiable. And so when you're working with a company or shopping
Mhm.
around with several companies, see which ones you can play with. And some companies might actually just wipe away an appraisal fee. For example, if you've
Yeah.
had a house built in the last couple of years and things like that.
Yeah, and also be aware before you sign on that dotted line that they're not tossing in a bunch of junk cost. I've
Right.
seen I've seen areas where they toss in a, administration fee or a mailing fee even though they didn't
Hmm.
mail anything, or you they just they'll just put in all those other small things that in the big grand scheme of things it doesn't seem like a big deal, but they just try
Right.
nickel and dime you. And just before you sign that dotted line, make sure you check those things aren't out there. And a lot of the times those can be negotiable and just say, I'm not paying those.
And always remember that they are a business, right? So they're there to make
Yeah.
money. So paying fees isn't a bad thing when you're refinancing. Because remember, at the end of the day, your ultimate goal is to pay less overall than your current situation. So decreasing your interest expense, potentially paying off your house faster. And so, one really
Yeah.
good way to look at this when you take into account your closing costs and you take into account your refinancing and the interest rates that you're getting is what they call a
Yeah.
break even analysis. And what a
Yeah.
break even analysis ultimately does is it takes, how much you have to pay to refinance. So looking at those
Yeah.
closing costs, and then how much you are saving over the course of your loan. And, how long does it take you to recoup those costs upfront and then start to, see the positive benefits of refinancing.
Yeah. This is one of those bar napkin calculations too. Just want something really quick and try figuring it out of what you want to do. But it'd be something as easy as, you had you had a 5% interest rate now, and say your new one's 4%. Because I don't think you'd refinance to get a higher rate.
Right.
So right there, you're saving that 1%
Hmm.
per year. And say that went on to that $100,000 that we've been using all along, and saying, all right, I can save about $1,000 annually. I mean, obviously it's just very general numbers. And
Right.
then you
Right.
say, all right, and then my closing costs came out to be $2,000.
Hmm.
You take that $2,000 and then you divide it with that 1,000 of your savings per year and say, all right, it's two. And that two stands for 2 years is your break even. So if you're going to be staying in that house for longer than 2 years, then it's a potential green light to get a refinance. I guess
Hmm.
I don't want to say green light, but it can kind of get your gears going saying, maybe it is something I do want to look into
Yeah,
if you're
you're
going
going
to
to be on
be
the
in
positive
less
side after those 2 years, right?
as far as costs go.
And I think another way to look at it too is when you're looking at the change in your monthly payment. So you have a current monthly payment, you refinance, you have a lower monthly payment. That difference, you can also divide that from the closing costs. And that's going to give you the number of months that it's going to take for you to recoup your closing costs or your, those upfront costs to this refinancing. And I think it's really good when you look at a break even analysis because it does show you
Mhm.
like, hey, in 2 years, I'm going to be on the positive end of this. I'm going to start saving money, even though I had
Yeah.
this upfront costs, but I know I'm going to be in my house for 10. And so I know I'm going to have
Yeah.
8 years worth of benefit.
As we're going through this, it's making me think that we almost could have added this above as one of your whys of
Yeah. That's
refinancing. How long are you gonna stay in your house for? Are you
right.
trying to flip it, or do you know you're gonna be moving on to something else soon? Where if you're gonna be finding a new house within 5 years, why even go through the hassle for these refinancing?
That's a
That
really good point. I think that, learning and understanding of what your situation looks like in the future, obviously no one can predict it, but I think it's really important to understand that so that you can have at least a general idea of, hey, does this work for me? And do the numbers work out?
Yeah. And then after this break even analysis that you may be going, but before you got those actual numbers, a way to do that is just like really shopping around for all these different rates.
Hmm.
There's things online you can go for. You can call banks if you want to stay local, you could call. But I would say if you're going to be shopping around for these rates, try to get as much apples to apples comparisons as possible.
Yep.
It's if you want to go out and do it, try doing them all on the same day or an email format so you can really see them one by one. And these rates can change daily. So if you don't have them sent out on that day, it might seem like you're getting a better rate from somebody else, but it might just because the rates got lower or
Yeah, that they do
increased.
fluctuate so much that you do, yeah, you have to look at that apples to apples basis to make sure that you're really understanding where you really are from all of these different competitors. I will say that when you do refinance or you're looking to refinance, you really have the leg up on your current mortgage company. So there's a really good chance that your mortgage company is going to see that this new company is asking for loan information, and then they probably are going to reach out for you and say, "Hey, can we help you?"
Yeah.
And so I think my advice there is see what they're going to offer you, but don't provide any competing information to them. Just say, "Hey, listen, yes, I'm looking for a refinance. I've got this really great deal with, this other company. What is the best that you can provide me?" And really put it on them to come back and have a competing offer because they want to keep your business.
Yeah. And keeping the business is an interesting point, and the reason I say that is I just heard recently, and it's probably been around forever, but and it makes sense. But there state you can potentially call your bank if you're like working with your bank and ask for a rate modification. And you just call in there and say, "Hey, can I do a rate modification process? Or do you offer it?" And with that, it is almost exactly what it sounds. You stay in with your
Mhm.
bank, you stay in with your same amortization schedule, but instead of going through the whole refinancing process, you say, "Hey, I'm pretty high right now for my interest rates. I want to work with you. Is there any chance you can get the interest rates more in line with what they currently are?" And there may be some fees associated with that, but there is a chance that they do offer that program, and there is a chance that you can get that lower rate without going through all the paperwork.
Which could be an excellent, alternative to a full-on refinance. So it's definitely something to keep back or to keep in your back
Yeah.
pocket when you're looking at refinancing or whatever it is with your current mortgage.
Make sure you do it from a position of power and using that leverage and
Yes.
saying you are wanting to look around for other things. Because if you're not going to say you're actively looking for other items, they might just say, "Nah, we don't even offer that."
A position of power and actually just go out and do it or actually reach out to other companies because it might seem very tedious and time consuming, and trust me, I don't particularly care to go out and shop for whether it's car insurance or refinancing or
Yeah.
whatever it is, but you
Yeah.
can save yourselves thousands of dollars doing this, and I think that it's a really good thing to look at and consider, obviously depending on your current situation. Don't be afraid to go out there, like Drew was saying, take that position of power and really just run with it and see what kind of offers you can get. Because at the end of the day, you can always just say, "Hey, no, thank you. I'll just stay where I currently am."
Yeah.
So, Drew, that was a lot. I mean, we dove into a lot of the weeds there. I feel like threw a lot of information out at our neighbor here. What are some of the, one or two key takeaways that the listener can take back with them into their personal life when they're thinking about refinancing?
Yeah, mine would be almost what I've said a couple times in this episode, and it's finding your why for refinancing. You just
Hmm.
hear refinance, refinance. It's going to be a really good idea, but you have to know that it's really your personal or household decision, and it's unique to your household. And that's a big thing of saying you want or you really want to make sure you know why you're going to be doing that. And there's so many options out there. I just hope that we were able to lay out a few to get your mind moving a little bit.
Hmm.
And hopefully you can find that why or makes you think about why exactly you want to do it.
Yeah, find your why first, but then even run the numbers and really get an understanding, big picture, what this is going to do for your financial situation. So get an
Yeah.
understanding of, if I refinance, am I winning doing so? Am I saving money on interest? Am I
Yep.
paying my house off faster? Really understanding that is so crucial on top of your why, almost secondary to your why, but you really need to know, what that big picture looks like um, when you're looking to refinance.
Yeah.
All right, Drew, before we started podcasting here, I walked out to the mailbox and we have another excellent question from one of our neighbors.
In the mailbox. Why does all the mail go to you? Haven't got anything yet.
To be honest, I think all the neighbors are picking someone that they like more than the other. I won't say which one, but I think they might be leaning one way. But
Hey.
this week, our neighborhood question comes from our neighbor, and she asks, "Hey guys, I have $25,000 sitting in cash with no debt, and I'm set to retire in a couple of years. What are some options I have for this money?"
Yeah, that's a great question. I don't think there's enough information in there for us to talk directly to our neighbor there. I would just say, though, with this type of a question, you have to start thinking about, do you have an emergency fund already? If you don't, maybe it's a good time to start thinking at your monthly cost and figuring out, do you want emergency fund for 3, 4, 5, 6 months, maybe even a year?
Hmm.
After that's filled up, you don't I think the timeline when saying about to retire is also an interesting part of it. And it's saying, okay, maybe you're getting close. You don't want it to be too risky. So you have to think about your
Hmm.
risk tolerance. I want to say here again, and just say, maybe it's keeping it in cash is not a horrible idea. Just it's not the worst thing to just have there. Obviously, you don't make great interest on a savings account, but it's not going anywhere,
Hmm.
and you just have that cash very liquid.
One thing you consider though, if you are keeping it in an emergency fund, is they have high yield savings accounts. So
Yeah,
that might be a really good option for you if, say, you're banking at your brick and mortar bank and they're offering you 0.01%. Well, these
yeah,
high yield savings accounts, and I don't know the exact yield right now, but they're going to offer you 1 to 2% on that savings. So that might be a really good option if it's something that you're just planning to park and you're still not getting enough return that might beat inflation, but it's doing a
mhm.
whole lot better than sitting in the brick and mortar 0.01% account.
Yeah, and that's almost, those rates, sadly enough, are pretty close to some bonds out there, depending on what
Right.
your bonds are. So you always hear bonds are less risky and you go into it as you get closer to retirement. But these high yield savings accounts, that's not a horrible option either.
All right, Drew. So that wraps up
Mhm.
this episode. But before we really sign off and say goodbye to our neighbors, what the heck has been going on in your neighborhood for this past week?
This past week, I'm trying to think. Nothing really pops in my mind of anything mind blowing, but this upcoming weekend, my wife has her first baby shower. So that's kind of exciting. It's going to
Yes, very
be
exciting.
it's going to be a couple hours away from our hometown, and
Nice.
I will be joining her, not for the shower, but but I'll be joining her down in the location and just kind of hanging out with, friends and family, and I might even sneak over to your house, Kevin.
We might have something in store for the neighbors after this week. Who knows? We might have some planning here in the neighborhood happening.
Yeah, maybe I can be the one to go to the mailbox and find some mail. So that's kind of the big thing I got going on. I know it didn't happen last week, but it's going to be happening this upcoming weekend, so I'm going to have to find something for next week as well.
I always thought baby showers were quite exciting because, as the dad, as the husband, you don't do anything, but you get to reap all the rewards. You get all the baby stuff. As sad or bad as that may sound, it is pretty cool to, not have to go to the
Yeah.
party. But hey, now you have all the baby stuff ready to rock.
And if there's anybody listening to this that is at that baby shower, I do want to say thank you in advance for the thought and hanging out with Jordan and the gifts.
Yes, we're kidding here, obviously, on the podcast. It's always well appreciated. Any type of event like that when you get to celebrate such wonderful occasion in someone's life.
Yeah. How about you there, Cav? What do you got going on?
Yeah, this last weekend we went to an apple orchard and did all of that stuff, picked apples, brought our kids there, went with my mother-in-law and really had a really excellent time. But the best part about it is that with those fresh apples, I actually, took a little page from Drew's farming/cooking playbook and made my first ever apple crisp last night. And let me tell you, I was pretty impressed with myself because it turned out to be not too bad.
Did you save any for the rest of your family, or do you just eat all yourself?
Hey, to be honest, I only had a little bit and that whole apple crisp was gone by the end of the night. So I'm going to say that that was a compliment to the chef.
How did your kids like it?
Oh, loved it, man. He just absolutely ate it up after he burnt his mouth a little bit on the first bite.
He's
But
toughening it up.
but yeah, he definitely ate it up and was super pumped. And then obviously with, a toddler, feeding him a bunch of sugar, he was hyped the rest of the night.
Running around the house.
Yeah, definitely. He's super into dancing and singing. So he was on his boogie train and I mean, I couldn't even keep up with him. It was pretty impressive.
Well, there you go. All great things happening in the neighborhood. With that segment concluded, that brings us to the end of the episode. So, if you're new here, we'd love if you guys could follow us on social media, Instagram, Twitter, Facebook. If you guys could, if you're watching on YouTube, give us a like, give us a subscribe, maybe even a comment. Let us know what you want to know for future episodes. That'd be awesome. With all things considered and said, we'll see you next week in the neighborhood.